Did you know that as of 2021, Americans owe over $1.3 trillion in auto loan debt? That's more than the GDP of most countries. A staggering truth indeed, and a testament to the prevalence of car loans in the USA. Car loans have become a staple in the American vehicle purchasing process, providing a crucial bridge between desire and ownership. But, as with any financial commitment, understanding the intricacies of car loans is paramount. It's not just about getting the keys to your dream car. It's about understanding the terms, knowing the pitfalls, and planning for the commitment. It's about being aware of the choices you have and making the most informed decisions. After all, knowledge is power, and in this case, it might just save you a good chunk of change. So buckle up as we navigate the often confusing world of car loans. So, what exactly is a car loan and why should you consider one? A car loan, in its most basic form, is a financial agreement between a borrower and a lender. The lender provides the funds needed to purchase a vehicle, and the borrower agrees to repay this amount plus interest over a predetermined period. Choosing a car loan can offer several benefits. It can make owning a vehicle more attainable, especially for those who are unable to pay the full price up front. Car loans also offer flexibility. Depending on your financial situation, you can choose either a secured or an unsecured car loan. A secured loan requires collateral, typically the car itself, which means the lender may repossess the vehicle if you fail to make payments. On the other hand, an unsecured loan doesn't require collateral, but usually comes with higher interest rates. Choosing the right type of loan can significantly impact your financial future. Before you rev up your engine and start applying for a car loan, there are some key things to consider. The first and foremost is your financial health. It's crucial to take a hard look at your financial situation to determine whether you can comfortably manage the car loan repayments. This includes evaluating your income, your credit score, and your existing debts. Your credit score, for instance, plays a significant role in determining your eligibility for a car loan and the interest rate you will be offered. A higher score often translates to lower interest rates, which can save you a considerable amount of money in the long run. If your credit score is less than ideal, it might be worth taking some time to improve it before applying for a car loan. Your income and existing debts, on the other hand, will help you understand how much you can afford to borrow. Lenders typically use something called a debt-to-income ratio, which is your monthly debt payments divided by your gross monthly income, to assess your ability to repay the loan. A lower ratio means you have a better balance between debt and income, making you a less risky bet for lenders. Once you've assessed your financial health, it's time to determine your budget. This is where the 24-10 rule comes in handy. The rule suggests that you should make a down payment of at least 20%, finance a car for no more than 4 years, and keep your monthly car expense, including your payment, insurance, and fuel, to under 10% of your gross income. This rule is a good starting point to ensure your car purchase won't strain your finances. However, remember that everyone's financial situation is unique. You might find that you need to adjust these numbers to fit your circumstances. The key is to set a budget that aligns with your financial goals and stick to it. Remember, a well-planned budget is your roadmap to successful car ownership. Now that you've got your budget in place, it's time to shop for a car loan. This process can be as simple or as complex as you make it. The key is to research. There are various lending options available, including banks, credit unions, and online lenders. Each lender offers different interest rates and terms, so it's essential to compare and find the one that suits you best. While exploring lenders, you'll also want to check your credit score. You see, credit scores play a pivotal role in loan eligibility and interest rates. A higher credit score can help you secure a loan with lower interest rates, saving you money in the long run. If your score is less than stellar, don't fret. There are ways to improve it, such as paying off existing debts and ensuring timely payment of your bills. Once you've done your due diligence on lenders and your credit score, it's time to get pre-approved for a loan. Pre-approval is like getting a green light before you start the race. It gives you an idea of how much you can borrow and at what interest rate. Not only does this information help you stick to your budget, but it also gives you a head start in the car buying process. To get pre-approved, you'll need to provide your chosen lender with some information. This typically includes proof of income, employment details, and sometimes details of the car you intend to buy. The lender will then review your application and, if all goes well, give you a pre-approval letter that you can take to the dealership. Now, why go through all this trouble? Pre-approval can give you a competitive edge when negotiating for your dream car. It shows the dealer that you're a serious buyer with financing ready to go. This can put you in a stronger position to negotiate the price of the car and potentially drive away with a better deal. Pre-approval can give you a competitive edge when negotiating for your dream car. So do your research, check your credit, and get that pre-approval. Happy car shopping. Understanding loan terms is crucial to avoid any speed bumps on your journey to car ownership. Let's start with interest rates. Think of these as the cost of borrowing money. The lower the rate, the less you'll pay over the life of your loan. Rates can be either fixed or variable. With a fixed rate, your monthly payments remain the same throughout the loan term. A variable rate, on the other hand, fluctuates over time based on market conditions, which can make your payments unpredictable. So it's important to consider what type of rate best suits your financial situation. Now, on to loan terms. This refers to the length of time you have to pay back the loan, typically expressed in months, such as 36 or 60 months. A shorter term means higher monthly payments, but you'll pay off your loan faster and pay less interest overall. A longer term, while reducing your monthly payments, will cost you more in interest over time. So it's a balancing act between what you can afford monthly and how quickly you want to be debt-free. Finally, we come to the down payment. This is the amount you pay up front for the car. The larger your down payment, the smaller your loan needs to be. This means you'll pay less in interest over time, and your monthly payments will be lower. A common recommendation is to aim for a down payment of at least 20% of the car's price, but the more you can afford, the better. Remember, all these factors are interconnected. A lower interest rate, a shorter loan term, and a larger down payment can each reduce the total cost of your car loan. But they also affect your monthly payments and how quickly you can pay off your loan. A lower interest rate, a suitable loan term, and a significant down payment can save you a lot of money in the long run. So buckle up and make these decisions wisely to ensure a smooth and financially sound ride to car ownership. Ready to hit the gas and apply for a car loan? Here's what you need to know. The application process typically starts with submitting a loan application form. You'll need to provide information about your income, employment, and credit history. It's also a good idea to have your financial documents at hand, such as tax returns and pay stubs. Once your application is approved, it's time to shift gears and start negotiating. Yes, you heard it right. You can negotiate your car loan terms. You can discuss the interest rate, the length of the loan, and even the down payment. Remember, the goal is to secure a deal that fits your budget without straining your finances. Don't be afraid to ask questions and always read the fine print before signing on the dotted line. Negotiating the terms of your loan can be as crucial as negotiating the price of the car. Once you've secured your car loan, the journey doesn't end there. Now, it's all about managing it effectively. One critical aspect of this is making timely payments. These payments not only whittle down your loan balance, but also help improve your credit score, which can be beneficial for future financial endeavors. But what if your circumstances change and the current loan terms become a bit too steep? That's where refinancing comes in. Refinancing your car loan means replacing your current loan with a new one, often with a lower interest rate or longer repayment term. It can be an excellent way to reduce your monthly payments and make your loan more manageable. However, be aware that refinancing might also extend the life of your loan, meaning you'll be in debt for a longer period. It's a balancing act, and you need to weigh the pros and cons carefully. Remember, consistent on-time payments can boost your credit score, and refinancing can be a lifeline if you're struggling.